Okay, Jay, thank you so much for joining me on my first Zoom call. As you know, I go to you for my market insights on a regular basis, and I thought the other day, what better way to bring to my clients insight into the market than to bring you on in person to answer some really key questions that I know my clients are asking me on a daily basis. So thanks for joining.
I'm honored. Thank you for having me.
So,
shoot away.
Great. So one of the things that I personally find frustrating, and I know a lot of clients kind of come to me, is that there's so much to read about what's going on right now in the market. So you can read articles about how the market's recovering, how it's crashing, how the housing bubble's coming, how it's not going to crash. And so I'm really a big proponent on going to one source that I really, really trust, and that is you. So what are you seeing right now? What are you seeing in the market? What are you seeing as a takeaway? Anything that you feel maybe some myths need to be debunked? Yeah, let us know.
It's been very interesting in the last month or so. In about the last 6 weeks, we saw a massive roller coaster of both panic. So about March 15th to March 20th, we saw basically what was set as a low for the year. And it kind of reached down to numbers that we hadn't seen since the 2008, 2009 crash in terms of volumes and in terms of what was going down at such a dramatic pace. So we saw at the kind of middle to the end of March, stock markets, bond markets, everything just went down. Everybody panicked. I think the technical term might be freaked out.
Yep, we all remember.
Slowly from there, right, and then slowly from there, markets have started to incrementally go back up. So I think they realized the world's not coming to an end. This is a very serious problem, but there are some things that will start to make money. There are some things that will be done by governments so for example, quantitative easing and governments dropping interest rates dramatically, throwing a bunch of money into different marketplaces, the bond market, the housing market in some degrees in terms of rents, rent relief and things like that, unemployment benefits that they're throwing in. So governments around the world, not just in Canada, really stepped in and kind of plugged up a big part of the hole. The question is now, and the question that nobody knows the answer to, is what happens next? So the challenge is there's two parts to that question. There's a medical part of that question, which I'm definitely not an expert on. And that's do we have a second spike? Do we have many more cases? Does it all slow down and come back in the fall? Nobody knows. I don't even believe with all the doctors know these answers. I definitely don't. So there's a health question there, and then there's an economic question. How long can people stay unemployed before they start walking away from homes if they can't afford their mortgages or things like that? So I think the one will answer the other in terms of if we get more data on the health side that gives us an indication that maybe we've peaked out and that we've flattened the curve, as they like to say, and they can get people back to work at a reasonable time frame. Again, what that time frame is, I don't think anybody knows yet. That can actually help the economics of things a lot, because if it's a 3-month stay-home problem and then everybody can go back to work and get back to a relatively what we viewed as normal before COVID came into our lives, then I think we're okay. It's severe. It's still a recession, but it's something that's recoverable. If it's a 6-month to an 18-month problem, that's a much deeper hole to dig yourself out of. So we won't know anything yet, but I think we're starting to get really good data on it now on the health side, and that I think will lead the economic side.
Amazing. Thanks. Yeah, no, it definitely does help for sure. And as you mentioned, right, no one has a crystal ball. I definitely don't when it comes to the market, you as well. So, but it's a great segue into the next question, which is, we heard from our Ontario Premier, Doug Ford, recently about reopening the economy, not a calendar, as he said, but more so just kind of a picture of the phases and how he's going to open up. Based on this and thinking that, assuming that everything stays the same and that we continue in this trajectory of recovery, what do you see happening in the next 4 weeks?
So I think that governments around the world, and I think if you've seen, there's been a lot of backlash on the isolation idea from a lot of parts. And I think that it's been partly just emotional frustration. People are very tired. People are like kind of at their wits' end in terms of being home with their kids and sticking it out and all that stuff. But I think part of it is also governments are trying to figure out that there isn't economic, like there's a health cost to shutting down your economy as well. So when you
Yeah.
look at the idea of anxiety, depression, suicide rates,
Totally.
the instances of abuse that increase when we see long-term isolation, there's a cost there as well. So
Right.
the governments are starting to have to balance between an outbreak of a pandemic versus the other health issues that are not being addressed as a result. So I think what we're going to see, and what we've seen in Europe and in Asia and in other parts of the world, you're going to see a gradual release of isolation. I think different governments are going to do it in different ways. Schools are a very big deal, and businesses are a very big deal. And I think
Yeah.
the one feeds the other. If you only are going to release kids to go to school for half a day, that doesn't mean that parents are free to go back to work yet. So they have to
Right.
kind of figure that part out. I know that's a struggle that's going on in Europe right now, where they've let a lot of kids go back to school for half a day, but that means parents are only able to work for 4 hours a day or something like that because there's no daycare. So I
Right.
think governments, I don't think anybody's really thought this process out, but from an economic perspective, I believe that we will start to see more activity in the next few weeks because they're gonna let it happen. Whether it's a good idea or not is yet to be seen. But I think it's going to get freed up. And then I think that's also been reflected in the markets. In the last few weeks, you've seen the stock market slowly inch its way up, kind of step by step. There's been a few days where it's gone back down again. But generally speaking, the market's gone up because there's a little bit of optimism that the economy's going to restart in some form.
Right. And as we know, so much of it is based on the psychological effects, right? All those kind of points that, yes. So again, kind of great lead into the thought about how long do you really think that this is going to affect the economy? So there's lots of media that like to use this as a comparison to the last, recession or the Great Crash. You've heard this, oh, it's as bad as the Great Depression, or I think it's really important to kind of point out the things that differ about this versus what we've seen in the past, and ease people's fears in that sense.
100%, and it's actually a really important point. So one of the things that I've been doing this now for 25 years, and we've gone through in just the 25 years that I've been an advisor, the Asian flu, the tech bubble, 9/11, the financial crisis in 2008, 2009. There was a couple other bad years just thrown in there just because they were bad, and now you've got this. So the one thing that I will tell you that is, people don't like to say everything like this is different than the last one, but they're all slightly different. The last comparison in terms of market volume and stock market declines and things like that is really the 2008, 2009 crash, and they're very different areas. The 2008, 2009 crash was a structural, massive bubble of one particular part of the market that kind of exploded over the rest of the market. It was structural in the sense that the whole market was at risk of collapsing in terms of the credit market. So like banks just stopped working for a while in 2008, 2009. So people forget very quickly that they talked about it being a Great Depression then. And they said, oh my God, these governments are writing all these checks and we're all going to have to be on bread lines and inflation is going to go rampant. And they said it all in 2008, 2009, none of it happened. This, on the other hand, I would liken it more to like a 2001, like a 9/11 event. This is an outside factor. This isn't something that the market did to itself. This came from nowhere, it shouldn't have come from nowhere, but in a sense that it wasn't structural, it wasn't part of the market. And because of that, my belief is that this gets fixed fairly quickly once the health issue gets resolved. So whether it's isolation, whether there comes a vaccine, even if it takes a year, whether there's treatments, whether there's antibodies, we read all these things, because this is something that happened to us that's not market related, the market can pretty much adjust very well once it's gone. The impact of this pandemic on how we lead our lives going forward, I think, is going to change. But that also presents market opportunities as well. So, from a perspective of how is this different, this is unusual in the sense that it's dramatically shut down economies. The last time this happened was 100 years ago in the Spanish flu. And when that happened in 1918, they also shut down economies, but the difference was the economies just weren't that big. But very similar things happened. It didn't take very long for that hit to come back. It was more like a V-shaped recovery. So a lot of economists and stock market people will talk about letter shapes. So they're talking about a chart, and whether it's a V, which means it goes down dramatically and then comes back up just as dramatically, whether it's a W, where there's 2 drops and then it goes up, whether
Right.
it's a U, which means it goes down for longer, or if it's an L, that means it's a depression, right? So there's all these letters that we can talk about. I think
Interesting.
whether it's a V or a W, I think it's one of those 2. So, I think there's a significant risk that we can see another good drop. I think the news isn't completely out there yet in terms of the economic impact that's already happened, in terms of companies not making as much money, producing as many goods, things like that. But ultimately, this is a problem that gets fixed at some point, and when it gets fixed, things get back to relatively normal, and then we move on from there. So, interestingly, it's presented itself as interesting opportunities depending on lots of other factors, but I'm sure we'll talk about that. But this is very different from a market crash of 2008 from that perspective. It's nothing like it.
Amazing. And now officially my favorite letter is B. So before I let you go, I thought it would be great if you could leave us maybe with, that one tidbit that you're leaving with your clients, whether that's kind of like a calm, stay calm, carry on. I'm sure there's a lot of clients who are concerned about the drop in their investments. And then there's other clients that are really excited about maybe what the opportunities are out in the market. What's that tidbit maybe you want to leave us with?
Yeah, so basically what I would tell anybody watching is that this is a great opportunity if you've got the time frame. So this just goes back to the basics of investing, whether it's real estate investing or stock market investing or anything else. You have to look at all of the different factors that go in before you make that investment. How long can you afford to have this money in this particular market? What's your risk tolerance level? How much can you stand to watch an account that might look like a W for a long time before it goes back up? So, if you've got the stomach for that, I actually believe this is a very great opportunity. There are some really interesting things happening in different sectors. I think because of the way this has changed the workplace, the fact that we're doing these Zoom calls now, we do them with all of our clients now. They've adapted to it. Who hasn't bought groceries online now? Who hasn't gotten some advice from a healthcare provider online now? So there's really interesting opportunities for people who are in that particular place where they can take the risk tolerance, where they can take the time frame. If not, then you've got to take a look at, let's say, for example, if you're dependent on your portfolio, you need to make sure that you're diversified so that you're not just sitting in one particular market, that you're not just sitting in one place that's going to make it so bad if markets do drop again, which they could very well could. So I think it really depends on your time frame. Obviously, I think advice is worth paying for. I'm in that business, so I'm biased when I say it, but I think you are too. And, I should say that just as much as Rachel has been kind and said that she's relied on me for financial advice, I've been relying on Rachel for my real estate advice, and it's worked out really well. So, I'm a big believer in paying people who know what they're talking about. And I think this is one of those places where, and this is one of those times where if you pay a person who actually does know what they're doing, you can do really well in this environment.
I could not agree more, for sure. Thank you, Jay. This was awesome.
No problem.
I hope to come back maybe a month from now, which I'm sure will be a whole new world, and maybe give everybody an update
100%.
then. Awesome.
Absolutely.
Thank you.
Take care.
Have a great